So the next two sections in the text, chapters 12 and 13, provide analogous valuations to the dividend valuation. You'll choose one of the three. So this is going to be fairly straightforward. There are a couple of twists to this one. You guys will be done early. I can feel it. Which will give you some opportunity to focus on the final presentation. Not to leave, unless you want to. Cash flow based valuation. Dividends is the money that has been distributed to your shareholders. The free cash flow approach says what cash can be distributed to your shareholders. You may choose to, you may not choose to, but it's the cash that's available to shareholders. And we're going to look at this one. Dividends are just about shareholders. But with free cash flow, we can look at it two ways. We can look at it as it relates only for shareholders, therefore in the value of a share of stock, or what's the free cash flow to debt and equity holders, therefore what's the value of all your assets. You would use this approach if you were going to make an acquisition of a company. What's the value of the assets? So we'll talk about both. We'll talk about how you measure free cash flows. We'll talk about both of these models, and then we'll talk about the similarities, and there are many, in the calculations. So this is just background. We saw this at the beginning of the last chapter. Economic theory tells us projected future payments are the discounting back from year one to perpetuity of all your future payouts. In this case, those payouts will be measured by free cash flows, the center of the three, and it's very similar in many ways to dividends, but different in other ways. So this is the other side of the dividend-based model. This says you're going to value the firm based on cash flows that are coming into the firm, or flows into the firm, which creates the possibility of paying dividends. In any given period, they'll differ from your actual dividends because you could retain some of them. But at the end, when the company shuts down forever, it should be equal if you do things right. So what are these free cash flows? Free cash flows. So they're cash flows that are unencumbered, meaning they are not obligation to your other debt holders, or they're not necessary for operations, either day-to-day operations or capital expenses, so that you can increase your operations in the future. What's left are your free cash flows. There's some judgment in this, because the balance sheet isn't going to tell you, is it a free cash flow or is it an operating cash flow? It's not as clear as you want it to be, so it's going to require some judgment. So here we go, little math, I guess. Your operating assets plus your financing assets, that's all your assets, are equal to your operating liabilities plus your financing liabilities, all your liabilities, plus your shareholders' equity, right? It's how you divide these up. That's the challenge. So operating assets are cash, short-term investments that you need for liquidity purposes, accounts receivable, inventory, PP&E, intangibles, investments in other affiliated companies, things that are involved with the assets of the operation of the company, Financing assets are any excess cash you don't need day to day, that could be used for a dividend, or investments that you're holding because you're going to use them eventually to repay debt or to convert to cash. So these two together are all of your assets. And as I said, you'll need to use judgment to differentiate between the two. That's the same formula we just saw. Operating assets plus financing assets equals operating liabilities plus financing liabilities plus shareholder equity. Operating liabilities, these are the liabilities that you need day to day, or you have day to day, accounts payable, accrued expenses, taxes, deferred taxes, pension obligations, etc. A lot of your liabilities will be financing liabilities, notes payables, and other debt, and preferred stock, which is really debt when you look at the way it's structured. So quite a bit of your liabilities are going to be for financing purposes. Now let's do a little bit of algebraic manipulation right here. That's the equation we've been talking about. We're just going to rearrange it. So we have operating activities on one side of the equation and financing activities on the other. So just subtracting operating liabilities from both sides, subtracting financing assets from both sides. You have operating assets minus operating liabilities are equal to financing liabilities minus financing assets plus shareholder equity, which just hangs out there. Nothing dramatic there. We'll just call it net, right? So this is your net operating assets and your net financing liabilities. Then we'll be able to show our shareholders' equity is equal to the net operating assets minus the net financing liabilities. Now, if we think about this as a present value of future cash flows, the present value of the net cash flows to shareholders will be the present value of the net cash flows coming in from operations minus the present value of the net cash flows going out for the purpose of financing your debt. Okay, so this is getting us towards free cash flows. These free cash flows are used. I'm sorry. Now let's talk about it from the perspective of debt and equity. So these are free cash flows that could be used either to pay off your debt or for equity. So these are free cash flows to pay your interest, redeem dividend or pay dividends, or to buy back shares. So for debt or equity, you would use your weighted average cost of capital in this situation for debt or equity. But let's try to work our way through how do you come up with what the cash flows are before we figure out how to do the calculation. You start off with the statement of cash flows, the bottom line. What is the cash flows from operations on the statement of cash flows? Right? You add back, remember this is for debt and equity purposes, so now you're going to add back your interest expenses and subtract any interest income, net of taxes. Okay? Because you're measuring what's available to shareholders, you don't want to think about what's been paid to shareholders. Not creditors, excuse me. Then you look at your changes in cash requirements for liquidity. Changes in cash requirements for liquidity. If you need more liquidity, or don't need as much liquidity from year to year, you have a change in that requirement, and you subtract that out and add it back in. Because that excess liquidity that you need won't be available for your shareholders or your creditors. So you have to take it out. So that's your free cash flows from operations that you'll use in your calculation. Now you need to look at, do you need any other funds for capital expenditures? So these also would not be available for debt and equity purposes, and you'd subtract them out as well. So what you're doing is you're taking your statement of cash flows and you're adjusting it for what's really going to be left over for the purposes of paying first your creditors and then your shareholders. And here's our equation. It should look somewhat similar to what we've seen for dividends. Remember, this is for both debt and equity. So these are the free cash flows for debt and equity. Discounted that. This is the continuing factor here after the 5th year. Perpetuity factor, which we've seen before. Discounting factor. There was a question with the dividends. Notice, even though we're in year 6, we're discounting back 5 years T. Most of what we're thinking about, though, is not for debt and equity. We think about that some, but if you want to figure out a share price, we're looking at the free cash flows only for equity. Only for equity. It's a little bit different here. Remember, we either added back in or subtracted out interest expenses. That's no longer done. Because those financing expenses are not relevant for equity. It's not free for your equity shareholders to get. But these other items are exactly as they were for debt or equity. So no change there. And now we have to adjust for other financing activities. You might have more borrowing. You might have borrowed more money. That's more cash flows in. If you've repaid any financing, that's cash flows out. Adjust your cash for that. You have to look at your cash, your short-term assets, and determine whether any of them were related to financing, and adjust those. And then finally, preferred stock, which we don't handle too much here. So what you're trying to do here is just have remaining the cash flows that are available to be used for dividends if you so choose. That's what this bottom line is. Cash flows that are available for dividends. same model, except instead of the free cash flows for all debt and equity, this is just the free cash flows that are available for equity, but it's the model we know. Okay, has this similar or different? That's most of what we're going to talk about. Obviously, we need to practice it, right? We need to get a feel. I think we need to get a feel for what is a free cash flow and what's not a free cash flow. That's the challenge of this model. And you need to feel it. But first, let's talk about the similarities and the differences from the dividends model. Cap M is Cap M. Inflation doesn't matter. The growth rate is exactly as we would have calculated the growth rate or assumed the growth rate from the dividend model. It cannot be greater than your discount rate because it'll both mess up the math and it's irrational. It's illogical that you're growing faster than your investors require. Use the after-tax cash flows because debt matters as it relates to taxes. Infinity, but we're going to use the 5-year plan. You have to do the mid-year adjustment, just as we did. And you'll need to do sensitivity analysis as well. Okay, let's look at Pepsi. And I should have written down the page. 1 second. Say again?
887.
887, thank you. Yep, 887. Start with the net cash flows from operations on the statement of cash flows. And now we're adjusting. Remember, this is for equity only. This is not for equity or debt. Equity and debt. We're adjusting cash required for operations. It's not available to the shareholders. Cash flow from investments. Cash flow from debt financing. And there was a little bit of preferred stock here in year 1. So we now have free cash flows for the equity shareholders each year. Notice it's not all the cash that's available. It should be, in most cases, less. Not all cases would be a smaller number. You're adjusting out cash. So you have that for your 5 years. You discount it based upon the discounting factor, and you get your total free cash flows available to shareholders for the first 5 years. Once again, we will do our continuing value. Use the 5th year, multiply it by the perpetuity factor, discount it back 5 years, and you have your continuing value. And then together, mid-year adjustment, and should have, if your financials are right and everything is perfect, you'll have the same result. I think this is the same result as you would have seen in the dividend model in this case. A different way of approaching but get to the same answer. Seem easier or harder than the dividend model?
Hard.
Harder. Why?
Because you have to determine the free cash flows.
You have to, yeah.
That looks difficult.
It's confusing, right? Until you get some practice at it, it's confusing. So I would agree. When you're starting out, it feels harder. On the other hand, it has more economic meaning than dividends because dividends are arbitrary. It's up to management discretion. It focuses on what's available to the shareholders, whether or not it's actually distributed. Remember, you don't use the dividend model if you're looking to value a company. We didn't have a dividend model for debt and equity. Right? We just did the dividend model for equity. So if you need to value a company for the purpose of an acquisition, let's say, you'd have to use this or the net income model, which we'll do on Wednesday. So this one is used in practice. This one is investment bankers use this model. Disadvantage, there's a little bit of an art to it. Just like with dividends, this continuing value dominates the total. But we have, good, strong companies that are going to persist for a long time. And just like the dividend model, sensitivity analysis is key. And